Hey, thanks very much. Welcome back. It's Hurley in the Morning. Chuck Malamut is here, so the world is in balance. The world is as it's supposed to be. Chuck Malamut is our official financial advisor to the Hurley in the Morning program, our exclusive financial advisor. To reach Chuck, who is the managing director of his group at Morgan Stanley's Northfield office, you can dial the team at 609-383-2010. The following program that we do each week for the last 25-plus years on Tuesday at 8:05 is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast. They are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. A lot of ground to cover with our official financial advisor to Hurley in the Morning, Chuck Malamut, who is here right now. Good morning, Chuck.
Good morning, Harry.
Good to see you, my man.
Congratulations again on quite an accomplishment.
Did you see the paper?
I saw it online, yes. I was pretty impressed.
Ah, it's online, too. I got to go check it out.
Yeah.
I gave a very, very hearty thank you to the Press of Atlantic City because it's one thing, they didn't have to put anything in. They could have done something very small, and they actually did something rather significant, and I appreciate it.
Well, Harry, look, you've been at it for many, many years, and the golf is what, 9 years?
This is the ninth
year.
But you know what? And it's interesting. It is accurate because that's the way that Talkers Magazine put it out the last decade, because they're pretty much looking at the more formal, registered Hurley in the Morning charity, registered with the IRS, registered with the state of New Jersey, and all of that. But we, on an ad hoc basis, we did a lot in the first 15 years. It was just in a different way. It was on an ad-needed basis. It wasn't as formal as raising tens of thousands of dollars each year. It was more if a team needed a few $1,000s. And ladies and gentlemen, Chuck is like congratulating me. The way we did it is I've been very blessed to have people in my life like Chuck Malamut. I could go to Chuck Malamut. This is before the Hurley in the Morning charity, registered-wise, even existed. And I said, you know what, Chuck? These kids are running around in rags. I'm going to put up 100. Chuck would say, I'll do 500. He would always step up big. And that's how we were able to do it. And then we decided about a decade ago that we want to help even more people. Let's do this rather than ad hoc. Let's do this the right way. Let's do it big. Let's do it legitimate and registered and do it the right way. And we went in full throttle. And we've helped a lot of people, Chuck, and you've been a big part of that every year.
Harry, my pleasure, for sure. I mean, I'm looking forward to the golf at a new location.
Yeah, me too. In fact, we were just talking to each other yesterday, Harbor Pines and I, Alan and Debbie, about how excited everybody is. It's going to be a great day over there, Friday, June 17th.
Guaranteed no rain, for sure.
I hope.
It's been
Chuck, I'm always very squeamish about it because for 8 straight years, not a drop of rain has ever fallen on an event that's on the same exact day, basically, third Friday in June every year. So that floats between like the 17th and the 20th or something like that as the calendar moves. But we've been very, very blessed, very fortunate.
Must have all those officials from the government looking at you and making absolutely certain
the gods
that that there will be nothing but sun and warm weather at your golf tournament. So, and I was
we've
thinking,
been fortunate.
I was thinking on the way in, Harry. I know that we're not going to talk about politics. You and Kirk did a wonderful job in the last hour, but
thank you.
It's just amazing. This is only the beginning of March, and we have such a long way to go. And
people are going to be so sick of this. We're going to balance things on this program like we always do because people are going to be just so beaten down. Because it's just, look at the intensity now. Can you imagine?
As you ramp up to November, it's going to you won't be able to get out of the way. It's going to be everywhere, and I think, Harry, a good move on your part to balance the program because this is not a sprint. This is a marathon, and it's a matter of picking and choosing and dedicating an hour here or there for the event, and I'll call it an event because it's just so it's frustrating to see what's happening on both sides. I'm not going to get into the dynamics. I think your listeners clearly understand it, and I think tonight might be somewhat of a telltale sign as to where we're going, into the future. But and we'll leave it at that because
good comment, and I concur with your prescription, Dr. Malamut. All right, give us the market update, Chuck. How are we?
Well, Harry, it's amazing if you remember. There are a number of dates that you'll never ever forget about. You're never going to forget about the crash of '87 in October, for instance. Most recently, August the 24th, when we had that meltdown in the equity markets, when very, very quickly, there was a pricing differential a lot in the ETF world and a lot of individual stocks. And if you look at the stock chart now, it's pretty evident that it was sort of maybe a one-off, and it was China was to blame at that point in time. And then as we got into the beginning of the year, and we ended up with, back on that risk on, and no matter what you own, it was just, you just don't need to own equities at that point in time because all the pundits were saying, get out, get out, get out. Well, we get to February 11th, sort of hit that double bottom, and ever since then, I mean, and again, Harry, this reminds us of a conversation we've had I don't know how many times. Imagine you go away for an extended period of time, and you are disconnected, from technology, local newspapers, television, cell phones, computers, whatever, internet. And if you looked at the market today, and you looked at the market on January the 1st, you would say, okay, we're down ever so slightly. But you look at the road that we traveled, and it was not a straight and narrow road by any way, shape, and form. So,
doesn't it speak to really not just crushing yourself second by second, day by day? Because if you do exactly what you said, you let it shake out over a reasonable period of time, and it would be much easier to stomach and to process.
One of the things that we chatted about last week and spent some time with it was how important it is to have the proper asset allocation within a portfolio, and it is certainly proved out again. So when you look at the markets last week, Harry, now we have pretty much eliminated most of the losses that we incurred, in the first part of the year. The Dow was up 2.2% for the week. The S&P was up 2.6% for the week. And the NASDAQ was up over 2 3/4. Now, while that was all happening, the 10-year U.S. Treasury, the rate increased 12 basis points from 1.76 to 1.88. So what we're seeing, Harry, now is, last week in particular, the evidence of some stabilization here in our economy. The recovery remains fairly uneven, and any firming of growth, moving forward is going to lend support to the recent advances that we put in. And I mean, that says a lot. And one of the things that Morgan Stanley was big on this year was, domestic U.S., Europe, and Japan. And we're not seeing that work through mostly in Europe, but more so in Japan. But it seems at this point in time, if you look at the value side, that meaning stocks, large capitalization stocks that pay dividends. And we'll X out energy for a minute, and we'll X out the banks. But if you look at the other industry groups that have healthy dividends, we seem to think that part of the market should do relatively well as we get through the rest of this year.
Chuck, we've got about 2 minutes before our first break. Tell us about the February employment realities.
Well, Harry, I put that on the.
I know that unemployment is holding steady at 4.9%.
I had as I was putting our notes.
Are you
together,
proud of how I did that seriously with no sarcasm?
But I was thinking as I was getting, all of our information together for today's show. We typically come with anywhere from 3 to 5 topics, and we kind of put them in order. Mm-hmm. as I'm sitting there getting this all together, in the middle, I had the U.S. jobs growth sort of buried in the middle of what we would chat about. And I said, no, I think I really need to move that front and center for my good friend Harry.
I appreciate you thinking of me. And
Because-
I'll bite. I'll play along. We're at we remained at 4.9%.
Correct.
Which obviously, if that number could be believed, it would be a fabulous employment market, because that's beyond the model that said we could never really go below 5% because of people that either physically can't work, mentally can't work, so that 95% would actually be 100% employment. So we're better than that. But I do remember, though, there actually were maybe 20,000 more jobs created than had been forecasted?
That's correct. And then, Harry, there were revisions in the upward revisions in the prior months as well.
What kind of jobs are these? Are these government jobs? I mean, what kind of jobs are these?
We all know there's a lot of them are service-related jobs. I mean, clearly, we continue to lose manufacturing here in this country. A lot of the technology brain drain, and as I know that you and Kirk were talking about, on the show about college and the like and what happens, but there's so much, of that brain drain when the kids go back and they leave the U.S., they get educated here and they leave, and it sort of puts us at a disadvantage, to other particular countries, but 242,000 jobs were created, Harry, in the month of February. A couple ways to look at it. First of all, February is a short month to begin with.
1 day longer this year with the leap year.
We had, for the most part, relatively good weather throughout the country. If you remember where we were last winter, you just had multiple storms, one following another. If there was any negative news about the report, is the fact that we had a slight downtick in wage growth and a smaller number of hours worked. And one of the things the Fed is looking for is, to be able to hang their hat on increased wages. And increased wages ultimately should show up in increased inflation at the end of the day. And putting aside everything that's happened in the oil patch, and Harry, they have staged a rather nice recovery. That being in the equity markets in the last several weeks. The fact of the matter is, if you're not growing your wages, it's not going to be. You're not going to have that inflation that you need. So the Fed can hang their hat and say, "Okay, we're gonna move rates here now."
Brief timeout, Chuck. Good stuff. Good opening. Strong opening. We're at 19 minutes past the hour, closer to actually 20 minutes past the hour. More with Chuck Malamut. He'll be here until 8:45 this morning. Coming up at 9:05 for 30 minutes, Dr. Mark Newkirk. This is his regular monthly program. We're going to make up what we missed during the month of February next Tuesday from 9:05 to 9:35 with Dr. Newkirk. That'll be all about your pets, and it is a great program where Dr. Newkirk imparts a lot of important information. We return with Chuck Malamut, all about your financial matters, in just a couple of minutes. Chuck is our official financial advisor to the Hurley in the Morning program. To make him your official financial advisor, call Chuck's team, where he is the managing director of the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010, 609-383-2010. Back in 2.5 minutes. We're back, 23 minutes past the hour. Chuck Malamut, yours truly, Hurley in the Morning, all about your financial matters with Chuck. And a reminder to reach Chuck and his team, the Malamut Group, at their Morgan Stanley Northfield office, 609-383-2010. Are we done with the employment numbers, Chuck? Are we going to oil prices?
Well, Harry, it depends if you're done beating it up. So
here's what I've just accepted that the number is the number. I think that we should pay more attention. I don't know if I forget the number of it now. U 12 or whatever it is. That report that shows actual work participation rate is not a good number. So I'm not. Are our markets more driven by the unemployment rate or by the actual work participation
I
rate?
think it's more obviously the work participation rate.
Okay.
I think the markets clearly understand.
Why do they report the unemployment number then so champion? They don't report the other one.
Harry, it's because it's the way it's been done for years and years and years.
And then of course it's non-farm payrolls. I mean, give me a break. I mean, this is 2016. I mean, we have automobiles and not horses and carriages.
Yeah, so I guess we're not done beating up the
Nah,
employment report.
But
okay.
Look, it is 4.9%. I liked it better when you said people were actually starting to get increases. There are
but that was the previous report.
I know.
The
I understand.
problem here is that did not carry.
I agree.
through
I was
in the
going to say I
February
liked
report.
it before when you were saying,
Okay.
But now that has slowed. I'll tell you another thing that I think a lot of people listening right now understand. The last 7 years, there are many people that they're supposed to feel great. They still have a job, don't even think about asking for a raise. There are people that have not had a raise in 7 years. I know people.
Yeah, Harry, and if you look at across most industries, including ours, you continue to get compression and margins, and that ultimately is reflected in the wages or lack of increased wages. But there are some very, very bright spots, including technology as we know it. I mean, if you end up on the cutting edge in the right company or the right industry group, you can basically write your own ticket. So, if you look at the jobs that are being created for these college graduates, there's a lot of hiring in the technology space, and in our world, there's a lot of hiring as well as we're starting to see.
What is your vast knowledge tell you in terms of? I remember nurses getting done and getting their BSN, which takes about 5 years now, not 4. They were able to get 5-figure healthy signing bonuses. All you had to do was have your RN, BSN, even RN, and you were gold. Then it turned into no bonus. Then it turned into no bonus, and you can't even get a job. I think it's sort of the pendulum is swinging a little bit back because there are a lot of nurses that are older that are retiring. So I think nursing is again going to have a boom time. And then I could talk about other, lawyers that come out that can't get a job. And it's not just these two fields that I'm mentioning. It used to be, Chuck, and you were one of them. You had your degree from Cornell University, Hotel School of Management, coveted as can be, and you could write your ticket. You had multiple job offers. That's not happening anymore, my friend.
Well, I think, Harry, in some specialty fields in hospitality, you just mentioned, if you attend and graduate from the Cornells of the world, it still exists out there. In that niche market where you get multiple.
You'll have multiple offers.
You will.
Well, that's good. That's good to hear. So that's an improvement.
And again, you're absolutely right, because if you take a look at several years ago, as we got into the recession or came out of the recession, we'll call it, there was virtually no employment to be said. We, the older folks in the workforce, were continuing to extend their hours worked and not looking to retire. Mm-hmm. So now I think you're starting to see that give a little bit, and where people are understanding the quality of life and how important it is that it's great to work, but there is and if you have a passion in what you do, there's no doubt about it. I have a lot of passion in what we do, so I don't get up in the morning, and I know you certainly get up in the morning and get out of bed and say, "Oh, I have to go to work today." No, this is your life, and people that have embraced it, whatever they do, I think they live longer, healthier, happier lives. There's no doubt about it.
Chuck, if I throw out a general question to you that I don't think we've ever covered on your program, but this would not be advice to any one person, just general advice, because I often think about the fact my father worked from the time he was a tiny boy until he was 65 years old. He paid into Social Security for 50-some years. Never collected a penny. He died at 65. Generally speaking, is it a tough decision whether to take partial Social Security at age 62 or before the majority age? Because the downside is if you continue to work based on how much you make, the government takes a lot of your money back from you.
Yeah, and to go to one step further, Harry, if you take this as Social Security and you are working, a lot of that is taxable.
Yes.
Then the other question is, let's assume you retire.
But if you retire some can still retire at 65, some at 67 now, which is in my case. I got that going for me. Pay my whole life under one set of rules, and they set that up. So now I'm full at 67. And like you, I paid a lot into Social Security, not as much as you have, but I paid a lot into it. I can't imagine taking anything at 62 because of all the implications that we both know about, and I plan on still working.
Yeah.
But at 67, they can't take anything from you. You can make as much as you want, and it's not a taxable event at that point, right?
To take it, you're right. But look at it from the other extreme. Let's assume you do retire at 62. And now the question is, do you take your Social Security, the reduced benefit at 62, or do you take that benefit at age 66 or age 67? Now, what we have found is that on average, and I'm not a Social Security expert, that your Social Security income that you will be receiving on average increases, if you don't take it, by about 8% a year. So you're far better off waiting to take Social Security, full Social Security, or take Social Security for retirement age versus the reduced benefit at age 62.
And now, also if you intend to continue to work.
Yeah. Now, if you don't know, so the couple questions are, like, when is the break-even point? And the break-even point is usually, and we in our retirement analysis that we provide our clients and prospective clients, there's a whole section that we dedicate to Social Security maximization it's referred to. And what we find out, the break-even number of years is about 8 to 10. So if you can tell me, Harry, that you're going to live to age 77, then you're far better off waiting to take that Social Security at 67, assuming now you have the means and do not need that income, from ages 62 to 66 or 67. So, there's a lot of things that we do know. There's a lot of things that we do not know. But certainly, if you have the resources, you're better off, for the most part, taking or waiting to take your Social Security.
Yep, I agree with you completely. Of course, you never know if you're going to make it to 67. You should with the average life expectancy. But I agree with that, though, completely, because you take a big hit if you take the early. It's tempting because you're eligible. Yeah. But you take a huge hit.
You know what else is interesting about the analysis?
And it's not like you catch up. Nobody should think that every year you're going to get more and more and more and more. You might get a COLA, but we've had, 3 of the last 7 years hasn't even been a COLA.
You know what else is interesting about that report that we run? It pulls in the mortality automatically. And when we started this 25 years ago, actually, no, I'm sorry. We started 30 years ago.
Yes, you did.
Wow.
Well, we started the show then.
The average male lived to age 83, 85. The average female, age 85 to 87. That has now been extended into the 90s. The average
Every time I hear that, it doesn't even seem true, but
the average male is like 91.
Average?
And the average female, 93 to 93 roughly. So it's
crazy.
So
I look at that as like an extraordinary end of the equation, somebody living that long. But this is now average?
It is. And I think what's important, Harry, is that your listeners, we got off the track, and that's fine.
By the way, that is a problem, though, with all these baby boomers. Baby boomers retiring at 67, and if you live to 90, you're talking about collecting.
You have a lot of years that you have to be able to provide yourself an income stream to live.
Yes.
I mean, if you get anything out of today's exercise, if you haven't done the planning for getting asset allocation, for getting the stock market, for getting the bond market, if you haven't done the planning, Harry, there's no reason to watch the stock market because you have no idea where you're going and why you're going.
That's why I brought up, we got to get the break in real quick. That's why I brought up Social Security, because that is a part. When you sit down with Chuck, that is a part of what you will have this discussion with him, because you will know, because every other year, you can go on the socialsecurity.gov anytime, but every other year you get the estimate of this is how much you've paid into date, and they give you an estimate at your retirement year of how much you're going to get per month. Chuck, that's a very valuable number as you plan, because most people should not plan that Social Security is enough to support you for the rest of your life. In some cases, it could be.
On average, Harry, Social Security actually is only anywhere from 25 to 30% of what the average retiree uses to live off of right now.
So
the other 70,
it's a part of it.
The other 70% either comes from 401k, pension, savings, part-time work.
Yeah, continuing to work.
To get you to your 100%.
35 minutes past the hour. We'll be back. One more power segment with Chuck Malamut. For all of your financial planning needs, turn to the official exclusive financial advisor to the Hurley in the Morning program. More than 30 years in the business here on our program, for more than 25 years. The managing director of his group, the Malamut Group, at Morgan Stanley's Northfield office, 609-383-2010. One sit down with Chuck, and I promise you this. I can say this. I promise you this. You will understand why every single week I talk about his perfected concept of total asset management and the all-important asset allocation. You'll get it. You'll get it very, very much. We'll be back in just a few minutes. We're back 38 minutes past the hour. One more power segment straight ahead with Chuck Malamut, who's now going to give us an update on manufacturing activity. Chuck, how are we doing?
Well, Harry, we skipped over oil, I think. So
let's go back to oil.
Okay.
I checked it off on my list inadvertently, as though we'd already done it in the last segment. I have noticed that
the price of the pump is higher now.
It went up, but now in the last several days, though, it has stayed where it is.
The price, Harry, nationally speaking, has now increased to about $1.78. When we were at the end of December, it was at 2.04, and a year ago we were at 2.47. So you have seen obviously a decrease, but over the last couple of weeks, you're starting to see oil move up, and move up fairly quickly. So a lot of that is to be you have to factor in that now we're going to the summer blend, and that becomes more expensive. And then you've just seen increase in West Texas, which is going through into the price of the pump. But so we think that what has happened, we've hopefully seen the bottom with respect to oil prices. So over the next few months, U.S. production is forecasted to drop to roughly 9 million barrels a day. I'm sorry, we're at 9 now. We're looking to go to 8.5, and that should help prices increase.
Chuck, I saw a report. It was not a Morgan Stanley report, so I didn't trust it as much as I would have if it was a Morgan Stanley analyst. But it said that we could look at, as the rest of the year goes along, that the price of a gallon of gasoline may go up an additional 50 cents.
Yeah, don't be surprised, Harry, because
but I have to say, I mean, I know we get conditioned. When it was 4.5 going on, and for us, Chuck, as you use the same super premium that I do, we were over $5 at one point. That really affects a lot of people's lifestyle and discretionary spending and things that they have. But if we stay in that range of between $1.50 and $2 for a regular gallon of gasoline here in the metro market area, Chuck, I mean, that's doable.
It is doable, Harry, and don't be surprised that the price of West Texas, is in the mid to high 30s, which came from the mid to high 20s not too long ago. Don't be at all surprised. By the time we get to the end of the year, we're at $50, and that will then be reflected in higher prices at the pump, and that's not. I mean, is that
merely a reality of what goes up must come down and must go up again? Is that a cyclical event, or what would predicate that? What would that be about?
Well, Harry, it's supply and demand, and certainly if you look at what has happened in the price of equity, in equity prices that are associated with energy, and more so with fixed income prices, bonds that were in the energy patch. I mean, they were calling out for multiple bankruptcies in that space. Now, there have been a few, but I don't think we've gotten to the point where the market seems to be satisfied
Let me ask
they
you
were
about this
looking
one,
for more.
Chuck. This is a little tricky because, I mean, I certainly don't know the answer to it, but I know the question. The OPEC ministers really, got their back up. They hated seeing what was happening, and this was going down, 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 then below 30 a barrel, and they said they were going to tighten the spigot. They used to have so much more control than they have anymore. They never did tighten the spigot. Have they lost the control that they once had?
Yeah, I think they have, Harry. I think it's pretty evident that the market does not. I mean, it pays attention, but not as much attention as it did, say, a decade ago.
Right, because they made a statement they were going to tighten the spigot, and that used to be enough that prices would have gone up, but there was not even a hiccup.
Yeah. So I think so. Here's what happens. So if in fact we get this increase in oil prices, we continue to increase the number of people that are working on a monthly basis. Manufacturing, that was the next topic we were going to chat about. It has shown a slight improvement as we got through the month of February. The February Institute of Supply Management Index, increased during the month of February, and we seem to believe that's been because of the consumer spending, which all kind of tracks back into oil. So that index right now still is slightly below 50, and because we've had some problems internationally, that could be somewhat of a headwind as we move into future months. But that all kind of ties back to your friends at the Fed,
which is a good point to close on.
So we meet. There's a meeting in a not too distant future. Several months ago, everyone was predicting, after the December hike, that there would be a hike in March. The majority seems to believe that's not going to be happening.
What's the percentage in your mind that there could be an increase?
In March?
0 to 100%. That there will be an increase.
You never say never.
I'm not going to say 0, but I wouldn't go above 10.
I was going to say maybe 15.
Okay.
But I think beyond that meeting in March, I
don't think markets would like that very much.
No, they would not. So the question is, once you get through that March meeting, looking at economic growth, if it strengthens or weakens, and looking at global financial markets, what happens to those conditions? Do they improve or do they deteriorate? I have seen, Harry, anywhere from predictions from 1 increase to up to 3 in 2016. So that would mean that after the March meeting, they would need to go at the next meeting. But if you think about where we started today with the market bottoming in the middle of February 11th, and if you were astute enough to to keep your assets and not not liquidate or turn upside down your asset allocation, you have been rewarded for that by staying in the markets. So the Fed certainly understands that. And if you look in particular at certain sectors of the market, Harry, like for instance last week, the number one sector was energy, up almost 6%. So now as we are looking at the S&P and its across all sectors, roughly 5 sectors are up and 5 sectors are down. Year to date, the number one sector year to date is telecom, up about 12.5%. And the sectors that have not performed, Harry, I would think that you would probably say that energy might be down at the bottom as far as a non-performer. Well, actually,
I would.
Energy was the number 3
so it's
performer
coming back
year to date. It's up almost 2%. Financials, healthcare, and technology are the 3 at the bottom of the heap with respect to sector analysis within the S&P. So I think that we're going to probably get a couple increases if the economic reports continue to improve and the markets, continue to move in an upward bias. And, the one thing we haven't chatted about recently has been volatility. And, volatility for the most part has subsided somewhat, and that is always good news for any investor.
Chuck, before you go, is there any appetite for another round of quantitative easing?
I don't think so, Harry. I think
that ship has sailed.
I think
it's over.
I think we've exhausted that. I mean, the economy's got to stand on its own.
Where do we get from fractional growth? Because even if I believe that it went from 0.7 to 1 full % of GDP growth, where do we get? How do we get back?
I'm going to let you answer that question.
To 3% and beyond.
You go ahead. I think you have that answer.
All right. I do. With the free market. Let the free market go.
I mean, you and Kirk, said it, and you say it every time you're together. You got to take the handcuffs off, and you got to let businesses run their businesses. And if you can do that, if we can see into the future, I think, Harry, the more GDP will grow, and we will get back to that 3% number.
Great to be with you, Chuck. Thanks.
Hey, Harry, thanks for having me.
Meet again.
Talk to you soon.
He is Chuck Malamut, the official financial advisor to the Hurley in the Morning program, in our 26th year together here doing this program every Tuesday morning in the 8 o'clock hour. You can reach Chuck, who is the managing director of his group, the Malamut Group, at Morgan Stanley's Northfield office at 609-383-2010. And the following program that you just heard was presented by Chuck Malamut, a financial advisor at Morgan Stanley. The views and opinions expressed on the program are those of Chuck. They do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast. They're subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. We'll be back in just a few minutes. Open forum until the top of the hour, so get in. 609-407-1450. We dropped a bunch of calls, so come back. 609-407-1450. 8 minutes uninterrupted when we come back. And then in the 9 o'clock hour, half of it, Dr. Newkirk, coming up in about, 17 minutes from now. And then wide open forum from 9:35 until 10:06.